Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights. Market Insights is our weekly video series and publication that captures the events of the past week and extrapolates what they may mean for financial markets going forward. Let's get started. Now, this is our very first Market Insights, and I've already got to apologize because it's intended to be short and very topical, and this one is going to be a little longer than usual and very strategic. So, we'll be back on track next week, and all of those people who have been following my work for years and doubt that it will be shorter, tune in next week and I'll prove you wrong. So why is this one a little longer? Well, this is an update to our outlook, our mid-year review of how we're doing in terms of the strategic themes that we set for the year. We came into 2020 believing that the Federal Reserve printing the money to fund a budget deficit would probably prompt a market bubble in U.S. equity markets. We believed that at the beginning of the year when the Fed was printing $1 trillion. We believed it even more after COVID-19 required Congress to pass a $2 trillion stimulus bill, which added another $2 trillion, and we will believe it still further if, as we expect, Congress agrees on another stimulus package with probably about a $2 trillion price tag. That means the Federal Reserve will have printed and injected into financial markets about $5 trillion in 2020. That's a lot of money. It's got to go somewhere, and we think most of it, with bond yields close to historic lows, will probably continue to go to equity markets, with a little left over to push housing markets up into possible bubble territories, and the same with commodities. So, how should you position your portfolios if we're right and a bubble emerges? Well, first, let's acknowledge that positioning for a bubble inherently makes me uncomfortable. I've lived through a lot of bubbles in 35 years of investing, and they always fight against my basic instinct to buy low. But if you use a valuation strategy going into a bubble, you're probably going to miss out on some of the upside because momentum stocks tend to dominate in that kind of market environment. So how can we balance between valuation instincts and the recognition that momentum's important? Well, we believe 6 strategies should be incorporated into your portfolio. Number 1, big cap tech. It's a consensus trade. It's been working. We think it's probably going to continue. But importantly, we're saying big cap tech with multiples of about 30 to 35 times earnings. There are a lot of big cap tech stocks trading much more expensively than that. Our experience from the bubble of 1999-2000 is that kind of stock can sometimes take 20 years to get back to break even after the bubble has burst. By contrast, if you buy some of the more conservative big cap techs at lower multiples, you get plenty of participation in the bubble. Those multiples can go to 50, 60 times earnings, but if and when the bubble bursts, you have less chance of spending 20 years in the wilderness. Our second strategy, Europe. Europe has done a much better job in containing COVID-19 than the US has, and actually may be poised to grow faster than the US, both because of their better performance on COVID-19 and also because there, for the first time, is going to be a European-wide stimulus package with over $2 trillion in stimulus spending and $2 trillion in money printed by the European Central Bank. Europe trades at a much lower multiple than the US, and we think that this time valuation may actually work in a bubble-based market because they're going to get that money printing too. Our third strategy, US housing stocks. Home builders are in the catbird seat because COVID-19 interrupted construction in home markets. Inventories are extremely low. We have had record home sales and prices are rising 5–10% with unemployment at double digits. If unemployment falls next year as we expect, then we think home prices could go back into bubble area like we saw in 2004, 5, and 6. Home builder stocks are at much lower valuations than they were back then and have plenty of upside in our opinion. Number 4, swap REITs for banks. REITs, real estate investment trusts, own a lot of hotels, a lot of shopping malls, and they own a lot of office buildings. The future demand for all of those is very uncertain. REITs are down about 6%, but that hardly reflects the true uncertainty in their portfolio. Meanwhile, banks, do they face headwinds? Absolutely. There's going to be a lot of loan charge-offs, and interest rates at 0 has historically been very bad for bank earnings. But banks are down 30%. And they are taking action to charge off bad loans already. REITs have taken no action to address their challenging operating environment. Plus, banks have some positive catalysts. The telecommunications revolution, working from home, conducting business over telecommunication, that has the opportunity to really cut bank costs, and a lot of those costs are going to come out of the profitability of REITs. And yet banks at down 30% are much more distressed prices than REITs. We think this is a big opportunity to swap one troubled company type for another at a lower valuation and better upside. 5, commodity-based miners. So gold and silver are breaking out to all-time highs. We're uncomfortable, in all honesty, buying metals because they don't pay dividends and they don't have earnings that we can value. But the companies that dig those metals out of the ground, they have both. And while gold and silver are breaking out to all-time highs, gold and silver miners are still much lower than they were back in 2011, the last time we had a big rally in those precious metals. Last but not least, for investors with sufficient risk tolerance, commodities are made by companies, they're also made by countries. And there are a lot of countries whose stock markets are dominated by commodity producers. Chile, Indonesia, South Africa. For those who can tolerate the volatility, because there are a lot of problems that are confronting the emerging markets, but in these particular cases, we think that the printing of money can drive up those commodity prices, and historically that's been good for the economies and the stock markets of these commodity-centric emerging markets. So, 6 portfolio strategies that we believe will help your portfolio participate on the way up as the bubble inflates. We're avoiding some of the real excessive speculative strategies that will probably generate higher returns, but also give you more risk of getting caught if the bubble deflates suddenly and unexpectedly. We also really strongly recommend you take a look at the risk management strategy that we laid out in our Strategic Insights, How to Prepare for a Bubble. Our experience suggests that getting ready for the inflation of the bubble is the easy part. Making sure you don't give all that money back as the bubble collapses, that's where investors tend to struggle. We've laid out a potential risk management plan to help you also succeed in that trickier aspect of managing through the market's inevitable booms and subsequent busts. Thank you so much for watching this week's Market Insights. If you enjoyed the video, be sure and check out our website for other articles and important market information, and you can subscribe to this video below. We'll see you next week.